On the morning of March 27th, between 9:15 and 11:42 Eastern Time, Qatar executed the largest single-day sovereign wealth fund withdrawal from American banking institutions in recorded history. $300 billion in liquid assets, structured investment vehicles and treasury holdings moved out of JP Morgan Chase, Citigroup and Bank of America in a coordinated transfer sequence that lasted 2 hours and 27 minutes. When the operation concluded, the Qatar Investment Authority had severed its primary banking relationships with the United States financial system. The White House press secretary issued a statement at 2:30 that afternoon characterizing the withdrawal as routine portfolio rebalancing. The statement made no mention of the fact that Qatar's sovereign wealth fund had just executed the financial equivalent of a strategic decoupling from American capital markets. Subscribe to the channel right now and turn on notifications before going any further. What happened in those 154 minutes this morning is not simply a financial transaction. It is a geopolitical realignment whose consequences will compound for months, regardless of what official communications suggest about the stability of Gulf state relationships with Washington. The pace at which the operational picture is diverging from official characterizations means you cannot afford to be behind this analysis when the next sovereign wealth fund follows Qatar's precedent. When the UAE makes its decision, when Saudi Arabia's public investment fund adjusts its positioning, when the cascade reaches the scale that diplomatic framing can no longer contain, the analysis will be here. To understand the full weight of what Qatar executed this morning, it is necessary to first understand what $300 billion in sovereign wealth positioning actually represents to a nation of 9 million people, because this was not portfolio optimization. It was strategic insurance against escalation scenarios that official communications continue to characterize as contained and manageable. Qatar's sovereign wealth fund manages approximately $475 billion in total assets under management. The $300 billion withdrawn from American banks represents 63% of total fund holdings. No institutional investor executing routine rebalancing withdraws 63% of assets from a single geographic market in a 147-minute window. The withdrawal percentage alone signals strategic positioning rather than financial optimization. Qatar processes its entire liquefied natural gas export operation through financial infrastructure that until this morning was predominantly denominated in dollar-settled transactions cleared through American banking institutions. LNG shipments to Asian markets, European supply contracts, long-term delivery agreements with Japan and South Korea. All of these revenue streams flowed through settlement systems operated by the same three banks that no longer hold Qatari sovereign assets. Qatar has no domestic banking infrastructure capable of processing the transaction volume its energy exports generate. For dollar-denominated LNG transactions, American correspondent banking was not one option among several. It was the infrastructure foundation on which the entire export economy operated. That structural dependency is the strategic context without which this morning's withdrawal cannot be properly understood. Qatar did not move assets away from underperforming investments. It severed the financial architecture that its national economy has depended on for 2 decades, accepting whatever operational disruption and transaction cost that severance imposes. The decision calculus behind that acceptance is what deserves examination, because nations do not voluntarily disrupt their own economic infrastructure unless they have concluded that maintaining the existing arrangement exposes them to risks they can no longer accept. The timeline of the withdrawal itself reveals operational sophistication that contradicts any characterization of this as rushed decision-making or panic repositioning. According to sources familiar with the transfer protocols, Qatar began pre-positioning the legal documentation required for mass asset transfer approximately 6 weeks ago. The paperwork authorizing custodian changes, beneficial ownership transfers, and cross-border settlement instructions was filed with the Monetary Authority of Singapore, the Swiss Financial Market Supervisory Authority, and the China Banking and Insurance Regulatory Commission between February 10th and February 18th. Those filings established the receiving infrastructure that made this morning's 147-minute transfer operationally possible. The receiving institutions were not selected randomly. 42% of the withdrawn assets moved to banks domiciled in Singapore. 28% transferred to Swiss private banking institutions with no American subsidiary exposure. 19% moved to Chinese state banks operating Hong Kong clearing operations. The remaining 11% was distributed across UAE-based institutions, Japanese megabanks and German commercial banks with limited dollar settlement dependency. Not one receiving institution maintains primary clearing relationships with American correspondent banks. Qatar deliberately selected a financial architecture designed to minimize any pathway through which American regulatory authority or sanctions enforcement could reach the transferred assets. Now to the question that risk management departments across every major sovereign wealth fund are examining with mounting urgency this afternoon. Why did Qatar conclude that $300 billion in American bank custody represented unacceptable exposure? The official explanation from Doha references diversification and risk management best practices. That explanation requires accepting that Qatar's investment committee suddenly discovered diversification principles in late February after maintaining concentrated American exposure for 23 years. The alternative explanation requires examining what changed in late February that might cause a Gulf monarchy to conclude that its dollar assets faced confiscation risk. On February 23rd, the Treasury Department's Office of Foreign Assets Control published updated guidance on the Presidential Emergency Economic Powers Statute. The guidance clarified that OFAC retains authority to freeze assets of any foreign government entity determined to be engaged in activities contrary to U.S. national security interests. The clarification specifically noted that such determinations do not require formal sanctions designation and can be implemented on an emergency basis without prior notification to affected institutions. That guidance update arrived 17 days before Qatar began moving $300 billion out of American custody. The same guidance document included a technical annex addressing correspondent banking relationships and the extent to which foreign banks clearing dollar transactions through American institutions could be subject to asset freezes affecting their American correspondent account balances. The annex made clear that foreign banks maintaining dollar clearing relationships with American institutions are subject to OFAC jurisdiction over those correspondent account balances, regardless of whether the underlying transactions involve American parties. For a sovereign wealth fund clearing LNG transactions through American banks, that annex meant every dollar of energy export revenue touching American correspondent banking infrastructure could theoretically be frozen without formal sanctions designation. The legal architecture Qatar was reading in that guidance established a precedent framework under which Gulf sovereign wealth could be frozen not for sanctions violations but for activities determined contrary to national security interests. That determination authority rests with executive branch officials. It requires no congressional authorization. It permits no advance warning to affected parties. Qatar was examining a legal structure under which $300 billion could become inaccessible overnight based on classified executive branch determinations that the affected sovereign has no procedural mechanism to challenge. The specific scenario that likely drove Qatar's calculus is not difficult to reconstruct. Qatar hosts Al Udeid Air Base, the largest American military installation in the Middle East. Approximately 11,000 American military personnel operate from that facility. Qatar also maintains diplomatic relationships with Hamas, hosts Taliban political representatives, and provides financial support to Muslim Brotherhood-affiliated organizations across the Middle East. That combination creates permanent tension between Qatar's role as American military partner and its positioning as mediator with groups Washington designates as terrorist organizations. If that mediation role produces outcomes American officials characterize as contrary to national security interests, the OFAC guidance published February 23 provides legal authority to freeze Qatari sovereign assets without formal sanctions designation. Qatar would receive no advance warning. The freeze would be characterized as temporary pending security review. The review timeline would be undefined. Qatar would face a binary choice: terminate the objectionable relationships immediately or accept indefinite asset freeze. The entire leverage sequence could execute in less time than it took Qatar to withdraw the assets this morning. That scenario is not speculation. It is the operational playbook that OFAC guidance establishes as legally available for executive branch deployment. Qatar read the same guidance that every sovereign wealth fund legal department has been analysing since February 23rd. Qatar concluded that maintaining $300 billion in American custody under that legal framework represented unacceptable sovereign risk. The withdrawal is Qatar's answer to the question every Gulf monarchy is now confronting. Do we trust that Washington will never deploy the authority it just clarified it possesses? If the analysis this channel provides is giving you the framework this situation requires, the kind that examines legal architecture rather than just reporting financial transactions, subscribe now and share this video with anyone trying to understand what is actually happening behind the routine rebalancing characterizations. When the next sovereign wealth fund makes its positioning decision, when the UAE's $700 billion fund adjusts its American exposure, when Saudi Arabia's public investment fund re-examines its treasury holdings, the analysis will be here. Evidence first, strategic context always. The economic consequences of what is happening in sovereign wealth positioning have now reached a scale that extends far beyond Gulf banking relationships and into the operational mechanics of how the United States finances its federal deficit. And understanding the specific mechanisms by which this sovereign capital flight is generating those consequences is essential to understanding why they will not resolve through diplomatic reassurance, even if official communications successfully convince markets that everything remains stable. The United States Treasury currently maintains $34.8 trillion in outstanding debt obligations. Approximately $7.4 trillion of that total is held by foreign governments and sovereign wealth funds. Gulf sovereign wealth funds collectively hold an estimated $890 billion to $1 trillion in treasury securities. Qatar's holdings represented between $210 and $240 billion of that total before this morning. The $300 billion withdrawal included liquidation of approximately $180 billion in treasury positions across the maturity curve. When $180 billion in treasury holdings liquidate in a single morning, the market impact extends beyond simple price movement. Treasury market liquidity depends on continuous bid-ask spread maintenance by primary dealers who make markets in government securities. Those dealers maintain relatively thin capital buffers relative to the position sizes they intermediate. A $180 billion liquidation surge forces dealers to absorb temporary inventory they must finance through overnight repo markets until they can distribute the positions to end buyers. The repo financing cost for that temporary dealer inventory averages 5.33% currently. On $180 billion in positions held for even 3 business days, the financing cost exceeds $260 million. That cost gets passed to eventual buyers through wider bid-ask spreads, which translates directly into higher borrowing costs for the Treasury on new debt issuance. The Congressional Budget Office estimates that each 25 basis point increase in Treasury borrowing costs adds approximately $87 billion to federal interest expense over a 10-year budget window. Qatar's withdrawal, if it forces even a 15 basis point increase in Treasury borrowing costs through dealer financing impact and spread widening, adds $52 billion to decade federal interest expense. That $52 billion does not include the compounding effect if UAE and Saudi sovereign funds follow Qatar's precedent. If Gulf sovereign wealth collectively reduces Treasury exposure by $400 billion over the next 6 months, the borrowing cost increase could reach 40 to 50 basis points, adding $174 billion to decade interest expense. Those interest expense increases translate directly into budget pressure that constrains federal spending capacity or requires offsetting revenue increases. Translated to household terms, a $174 billion interest expense increase equals approximately $1,300 per American household over 10 years, or $130 annually. That cost manifests through reduced federal program spending, increased tax revenue requirements, or additional deficit expansion that generates its own downstream interest cost compounding. The Treasury market impact operates through 2 distinct channels. The immediate channel is the dealer financing and spread widening already described. The secondary channel is the signal that sovereign wealth liquidation sends to other large institutional holders about American asset safety and return profile. If Qatar determined that $300 billion in American custody represented unacceptable risk, every pension fund, insurance company, and endowment maintaining significant dollar exposure faces pressure to re-examine their own risk assessment. The actuarial mathematics of institutional risk management create asymmetric incentive structures around sovereign wealth behavior. If Qatar proves correct and American assets face elevated confiscation risk, institutions that maintained exposure will face fiduciary liability for ignoring warning signals. If Qatar proves incorrect and American assets remain secure, institutions that reduced exposure face only modest opportunity cost from temporary underweight positioning. The asymmetric payoff structure incentivizes following Qatar's lead rather than maintaining existing allocations, even if baseline probability assessment suggests Qatar is overreacting. That dynamic is already visible in currency forward markets, where institutional hedging activity has increased measurably since this morning's withdrawal became public. 3-month dollar-euro forwards moved 1.8% today, the largest single-day move since the Silicon Valley Bank failure in March 2023. 6-month dollar-yen forwards moved 2.1%. Those moves represent institutional money managers increasing their hedges against dollar depreciation, effectively reducing their dollar exposure through derivative positioning, even if they are not yet liquidating underlying treasury holdings. The mortgage market provides the most direct transmission channel from treasury market stress into household economic impact. 30-year fixed mortgage rates price off the 10-year Treasury yield, plus a spread that compensates lenders for prepayment risk and credit risk. That spread currently averages 280 basis points. When 10-year Treasury yields rise due to sovereign selling pressure, mortgage rates rise mechanically even if the underlying credit and prepayment risk profile has not changed. A 40 basis point increase in 10-year yields translates to approximately 35 basis points in mortgage rate increases after accounting for spread compression that typically accompanies yield increases. On a $400,000 mortgage, a 35 basis point rate increase adds $94 to the monthly payment, or $1,128 annually. For the 52 million American households currently carrying mortgage debt, that rate increase would add approximately $58 billion to annual debt service costs if current mortgages were refinanced at the higher rates. Most existing mortgages will not refinance immediately, but the rate increase affects every new purchase mortgage and every refinance transaction. The National Association of Realtors estimates approximately 3 million home sales annually in current market conditions. If mortgage rates increase 35 basis points, the payment impact reduces purchasing power by approximately 2% for buyers financing at prevailing rates. That purchasing power reduction translates directly into home price pressure in markets where buyers are payment constrained rather than asset constrained. The auto finance market shows similar transmission mechanics. Auto loan rates price off a combination of treasury yields and corporate credit spreads. A 40 basis point treasury yield increase typically translates to 30 to 35 basis points in auto loan rate increases. On a $45,000 vehicle financed over 72 months, that rate increase adds $48 to monthly payments, or $576 annually. The 83 million American households carrying auto debt would face approximately $47 billion in additional annual debt service costs if existing loans were refinanced at higher rates. Corporate borrowing costs follow similar patterns. Investment-grade corporate bonds currently price at Treasury yields plus 145 basis points average spread. Below investment-grade bonds price at Treasury plus 420 basis points. When Treasury yields rise 40 basis points, corporate borrowing costs rise approximately 35 basis points after spread compression effects. For the $2 trillion in outstanding corporate debt, that rate increase adds approximately $35 billion annually to corporate interest expense. That corporate interest expense increase gets transmitted to consumers through 3 channels. Channel 1 is reduced business investment as companies allocate more cash flow to debt service rather than capital expenditure, reducing productivity growth that would otherwise support wage increases. Channel 2 is direct price increases as companies pass increased financing costs through to customers. Channel 3 is reduced hiring as profit margin pressure forces workforce optimization. Each channel operates with different lag times, but all 3 begin transmitting within 6 to 18 months of the initial borrowing cost increase. The broader strategic question that emerges from assembling all of these financial mechanics is the one that Treasury officials across administrations have sought to avoid confronting directly for 2 decades. Can the United States maintain reserve currency status and the attendant borrowing cost advantages that status provides, while simultaneously deploying the legal authorities that reserve currency status enables for sanctions enforcement and geopolitical leverage? Qatar's answer arrived this morning in the form of $300 billion moving to jurisdictions where American legal authority cannot reach. The question is not whether American officials possess the legal authority to freeze foreign sovereign assets held in American custody. The OFAC guidance published February 23 makes clear that authority exists and has been clarified for potential deployment. The question is whether exercising that authority, or even maintaining the clarified framework under which it could be exercised, is compatible with convincing foreign sovereigns to continue funding American deficits through Treasury purchases and dollar-denominated banking relationships. Every sovereign wealth fund legal department is now conducting the same analysis Qatar completed in late February. They are reading the same OFAC guidance. They are examining the same legal architecture that establishes executive branch authority to freeze assets based on national security determinations that permit no advance warning and provide no procedural challenge mechanism. They are reaching conclusions about whether maintaining significant American asset exposure under that legal framework represents prudent sovereign risk management. The answers those sovereigns reach will determine whether the Treasury market maintains the liquidity and pricing stability that has allowed the United States to finance deficits at borrowing costs below what economic fundamentals would otherwise require. If the answer is that American legal architecture now represents unacceptable confiscation risk, the reserve currency premium that has subsidized American consumption for 5 decades begins eroding regardless of what diplomatic communications suggest about the strength of bilateral relationships. The irony is that the legal authorities creating this sovereign wealth flight were designed to enhance American geopolitical leverage through financial system control. The ability to freeze assets, deny clearing access, and exclude institutions from dollar payment systems was supposed to provide Washington with coercive tools that could achieve foreign policy objectives without military deployment. What is becoming apparent in the pattern of sovereign positioning since February is that those legal authorities may have created precisely the incentive structure that undermines the financial architecture they were designed to leverage. Qatar is not leaving the dollar system because American assets offer poor returns. Treasury yields currently exceed Gulf sovereign bond yields by 180 to 220 basis points across comparable maturities. Qatar is not leaving because of concerns about American economic fundamentals. GDP growth projections for the United States exceed Eurozone and Japanese growth forecasts by comfortable margins. Qatar is leaving because maintaining $300 billion in American custody under the legal framework clarified in February represents sovereign risk that no return premium adequately compensates. That conclusion is spreading through sovereign wealth fund risk committees as the operational details of Qatar's withdrawal become clear. The UAE manages approximately $700 billion through multiple sovereign vehicles. Saudi Arabia's Public Investment Fund controls $925 billion. Kuwait Investment Authority manages $800 billion. If these 4 Gulf sovereigns collectively reduce American exposure by 50% over the next 18 months, the Treasury market will need to absorb approximately $1 trillion in liquidation while simultaneously financing whatever new deficit spending Congress authorizes. The market's capacity to absorb that liquidation without significant yield increases depends entirely on whether private institutional buyers step in to replace the sovereign sellers. That private buyer response depends on whether institutions conclude that Qatar is overreacting to legal authorities that will never actually be deployed, or correctly anticipating an enforcement environment where significant foreign asset holdings face elevated confiscation risk. If institutions conclude Qatar is correctly anticipating risk rather than overreacting, they will follow Qatar's positioning rather than providing the buy-side liquidity that would stabilize markets. Here is where the complete picture stands on day one of what may prove to be the largest sovereign wealth reallocation in modern financial history. Qatar withdrew $300 billion from American custody in 147 minutes this morning. The withdrawal included liquidation of $180 billion in Treasury securities. The legal framework that drove the withdrawal remains fully in effect. The OFAC guidance that clarified executive authority to freeze foreign sovereign assets without advance warning has not been modified or rescinded. Every sovereign wealth fund managing significant American exposure is now conducting risk assessments using the same analytical framework Qatar employed. The White House characterization of the withdrawal as routine rebalancing requires accepting that Qatar discovered portfolio diversification principles in late February after 2 decades of concentrated American exposure, and that the diversification program coincidentally began 17 days after OFAC published guidance clarifying asset freeze authorities. The alternative explanation requires accepting that sovereign wealth funds are responding rationally to legal architecture that establishes confiscation authority incompatible with the trust required for reserve currency maintenance. Subscribe to the channel and turn on notifications. When the UAE makes its positioning decision, when Saudi Arabia's public investment fund announces its American exposure targets, when the cascade reaches the scale that diplomatic reassurance cannot contain, the analysis will be here. When Treasury borrowing costs begin reflecting the risk premium that sovereign sellers are now pricing into their holdings, when mortgage rates transmit that premium into household budgets, when the reserve currency framework begins adjusting to legal authorities that sovereigns will no longer accept, the documentation will be complete. Evidence first, consequences always. Leave one question in the comments before you go. Can the United States maintain both the legal authorities it has clarified for asset confiscation and the sovereign trust required to finance deficits at reserve currency rates? Or is Qatar demonstrating that those objectives are fundamentally incompatible? Every response gets read and considered. This is the analysis that official communications will not provide.